Hello everyone, it's Tracy here. I want to break down the basics of real estate investment trusts, known as REITs, for you because when I was looking at REITs many moons ago, I was finding it really confusing. There's so many REITs out there, there's so much financial jargon. I just want to make it super easy peasy for you, which is why I made this video for you. So I hope you find this super helpful. Give me a thumbs up. In today's video, I want to go through the pros and cons of owning REITs, especially if you ever want to own real estate without the hassles of managing a business. I also want to talk about, should they belong in your portfolio? I'm going to give you my perspective so that you can decide for yourself. I also want to talk about where can you find them? How can you do some quick research to figure out which REITs are for you? And most importantly, I want to talk about the biggest mistake that I see Canadian DIY investors making when they choose REITs and how you can avoid it. And most importantly, I want to talk about, hey, how to find a good quality REIT. So make sure you stay at the very end because I'm going to give you 4 actionable steps on how to look for a good quality REIT. Hey everyone, it's Tracy here. I'm a former engineer turned full-time investor. I've been investing in stocks and real estate in Canada as a DIY investor for many years, and I've grown my portfolio to a multi-million-dollar portfolio. Now, my expertise is helping Canadian DIY investors transition to a cash flow and wealth model using stocks and real estate so that they can create multiple streams of income and ultimately live their best life. If that resonates with you, then I recommend you follow my channel, hit the subscribe button and that bell notification button to get the latest and greatest videos coming to you every single week. So let's get back with the video. Now, just to level set, I want to talk about what are REITs. REITs is essentially a real estate investment trust, which handles a big portfolio of rental properties or real estate, okay? So just imagine you want to go buy that apartment building, but you know what? You don't have a lot of money. So you decide, hey, I'm going to introduce all your friends and family and basically anyone you know, and we're going to split this apartment building among hundreds of people you know. Well, basically, you just made your own REIT. That's what a REIT is. REITs are a great way to tap into the real estate market without, first, a ton of capital, and 2, without actually any hassle from you because you're not involved in the day-to-day business. You're letting someone else take over that. But before you get super excited and go jump in and go to your brokerage account and start buying REITs, let's talk about the pros and cons and decide, is this really for you? So here's some of the pros. You have the ability to buy real estate with very little money. You just get a tiny share of the company. Number 2, you can get monthly income. A lot of REITs pay a ton of their profits back to you every single month. So who doesn't like moolah? Number 3, it's highly liquid. See, when you own hard, tangible assets like real estate, well, you kind of have to wait for someone to actually want to buy it. And it could take months. Well, these REITs, well, you just click a button and you could buy it, and then you could click a button and you can also sell it. Also, if you always want to own like office real estate or commercial real estate, well, this is your way to do it and get exposure to it. But let's talk about the cons because there's always downsides to any investment. As much as it's so easy to just click a button and buy a REIT like RioCan, Smart Centers, keep in mind that there's no free lunch. See, you're giving up control because you're letting someone manage the real estate, which could be seen as a plus because you don't have to be involved in any way. But if you ever want to say, have a say in the direction, the strategy, the renovations, force appreciate the property, well, you have no say when you invest in REITs. And depending on the real estate manager, they can actually do a terrible job of managing the real estate and the property management. Next one is volatility risk, okay? If you are an emotional being, which we all are, but some people are more emotional than others and get really scared when they see the ups and downs in the stock market. REITs, although they're not as volatile as like tech stocks, but you know, when the economy shuts down, like during the pandemic and remember the financial crisis and Sears going bankrupt, well, those type of things could really tank the stocks and could tank actually pretty much any stock. So if you don't like seeing the ups and downs of the stock prices, this may be not for you. And this is one that could really kill it for you, especially if you're young. If you're looking for total returns, well, REITs are not going to be that exciting to you because they pay you monthly distributions and there's no free lunch. So capital appreciation is going to be very slow and likely limited because the only way a real estate investment trust actually grows is that they need to continuously reinvest into the real estate, force appreciate, do renovations, acquire more properties to increase the value of the properties. And that takes money. And as part of the capital structure that they have, which is to pay the majority of the profits, like 90% of the profits, back to you every single month after paying all expenses, well, there's only so much money left. So that's why capital appreciation is limited. Here's some considerations of why maybe they belong in your portfolio. And I'm going to use the acronym. I'm going to have some fun with the acronym REIT. So I'm going to say R is real. Okay, real estate. Haha, get it? Real. Okay, so if you like owning tangible assets, hard assets, and you've always wanted to own real estate without coming up with a ton of capital and being actively involved, well, this might be for you. E for easy business model. I mean, I imagine a lot of us used to be renters or still remain as renters. So it's a very easy business model. Maybe this is something you like. You like knowing how the operations work. So it might increase your confidence when investing REITs because it's an easy business model to understand. I for inflationary hedge. Okay, this is my favorite. I mean, with rising interest rates, with inflation, creeping up month over month, even though it's slowing down, it's still increasing. Well, real estate increases with inflation. So this is a great inflationary hedge if you always want to own real estate without the capital and yet get a hedge against inflation. Because if the real estate is located in great locations, well, they are worth more over time. And a bonus, if inflation increases, rents also increase. So, and there's a clause in a lot of contracts that if inflation increases, the real estate managers can increase rent to keep up with inflation. So then that means more cash flow over time and then more profits to you over time. And lastly, T for tax advantages. So real estate investment trusts have a lot of tax incentives, and that's why they can distribute the majority of their profits back to you. And if you hold it in TFSAs, RESPs, RRSPs, any registered account, well, you can get that monthly income and not get taxed on it. And this is so important if you are in the retirement stage or you want cash flow, reoccurring cash flow coming in every single month. REITs might be for you. Now, if you're interested in REITs and you want to, do a little bit of research and use a platform that's super easy peasy to use and super visually appealing, I recommend Simply Wall Street. I use the platform myself and I just went to the screener. I typed in Canada and then I easily filtered all the real estate related REITs and then boom, it shows all the Canadian REITs in Canada. And guess what? For all of my supporters on my YouTube channel, if you click on my link, you can get a free forever plan. Check out in the links below. Now, what's the biggest mistake I see investors do when they are interested in REITs? The number one mistake is chasing yield because, hey, naturally, I totally understand. The reason why you probably want to invest in REIT is because you're looking for cash flow. Who doesn't like having a little bit of moolah every single month? But the thing is, with all the different REITs out there in Canada, they have all different types of yields. And if you're just chasing yield, there's no free lunch. If there's a very high yield, how do you know it's sustainable? And if you are relying on that cash flow, and when things turn the market, these REITs may cut their distributions to you. Okay, so if you're relying on the income every single month, they may cut those distributions and you'll have no idea why. And I'm going to be scared for you if you're relying on this to pay for your expenses, which is why I want to share the 4 things you must look for if you're looking for a good quality REIT. The first one is track record. Okay, we want to look for, I really recommend you look for a REIT that's been around for many, many different years and look at the market capitalization, which gives you the value of what the company's worth. Because a larger market capitalization gives you more confidence that a lot of investors are in this company. And a simple thing you could do is just look at a stock chart. Say you're looking at Smart Center. Look at the stock chart since inception of that company. Is it up? Is it down? That gives you an idea of the performance of that company and, well, of course, how many years it's been around. Number 2, a decent dividend yield. I mean, the reason why you're probably investing in REITs is because you want reoccurring cash flow every single month. So probably you're not going to be interested if the yield is like 1%. So what that means is that if the stock price is $100 and the yield is 1%, that means you get $1 every single year. I mean, that's probably not something you're looking for. So I would say go for a decently sized yield. Typically they range, 3 to 5%. Okay, so I would say go in that range so that you at least get a decent return and reoccurring income by owning this REIT. Number 3, now this is super, super critical. So please, careful attention. It's the payout ratio. Now, the payout ratio is different from looking at dividend stocks, okay? We're looking at a REIT. So the payout ratio is the funds from its operations per share. Basically, you just don't want the REIT to give you the majority, like over 100% of their profits back to you, because obviously it's unsustainable, okay? Like it's like you spending more than you make every single month. That is super unsustainable. You're going to get into a lot of debt. Well, same thing with a REIT. So we want to look for a payout ratio that is sustainable. Now, typically the payout ratios are going to be high because they are supposed to pay the majority of their cash flow back to shareholders. So I would say good target is less than 90%, if not lower, because the lower the payout ratio, that means, well, they can actually increase their cash flow back to you every single month because they can afford to. Number 4 is performance during the real estate crashes, okay? So look back during the times of 2008, 2007, look at 2002 when there was a tech bubble, look at during the pandemic and see how did these REITs perform? Did they cut their distributions? This is a big key. Obviously, during a market crash, the whole economy is not doing so well, stock market's not doing so well, so all stocks will drop. But because you are relying on this REIT for cash flow, and if you see that they cut their distributions during that time, then you may want to stay away from it, because I suspect the reason why you want to own this REIT is for that cash flow. Hey everyone, if you're a Canadian DIY investor and you want to own instruments, stocks that will pay you cash flow and grow their cash flow over time back to you, and you just want to have an easy peasy guide, check out in the links below. I have my ultimate guide to dividend growth stocks. Anyways, I hope you found this video super helpful. Give me a thumbs up and I hope to see you in the next video. Bye.